Welcome to the Explainer. So if you've ever stared blankly at a chart and felt like you were, just completely guessing, trust me, you are definitely not alone. But today, we're going to change that. We're taking a deep dive into the actual mechanics of institutional trading and breaking down a mechanical strategy that literally works across the board. Forex, futures, stocks, crypto, the underlying logic is exactly the same every single time. Price seeks liquidity, it displaces from key areas, and it retraces right before continuing. Today, we are decoding that exact sequence. Let's get into it.
But first, we really have to address a massive frustration here. Why do so many traders know all the right concepts, yet they still consistently lose money? Right? You see them marking up absolutely everything. They can easily spot fair value gaps, they nail the order blocks, and they see the liquidity sweeps happening in real time. They literally have the vocabulary down perfectly, but they still get trapped. So why does this happen? Well, it's because they're looking at these concepts in total isolation. It's like having all the right puzzle pieces, but missing the picture on the box. They lack the proper sequence to put the whole story together and actually catch those precision entries.
Okay, let's dive into this. Our main goal today is to build a rigid, rule-based order of operations. We're going to take these standalone smart money concepts and actually string them together into a complete mechanical entry model. Having a sequence, that's the real game changer. It's what stops you from blindly chasing fake breakouts, and it's what starts having you trade in lockstep with the big institutional money. So here is our roadmap for today. Number 1, the core concepts. Number 2, the 5-step entry framework. 3, aggressive versus conservative entries. And finally 4, context over pattern recognition.
All right, let's start with section 1, the core concepts.
Fundamentally, the liquidity sweep is the trap. This is exactly where price runs just above a previous high, or maybe just below a previous low, specifically to trigger a cluster of stop losses. Now to the untrained eye, it looks like a massive breakout. Retail traders get super eager and jump right in, but smart money is literally just snatching up that liquidity to fuel a violent reversal in the complete opposite direction. It's a classic fake out. Next up, we have the order block, which acts as the zone. This is the specific area where the real displacement actually originated. It's the exact location where large institutions likely stepped in and dropped a massive block of orders. Think of it kind of like the footprint of a whale. When a huge move happens, you don't try to chase the whale, right? Instead, you wait for the price to return to its original footprint before it continues its larger move. Finally, we have the fair value gap, or the FVG. Think of this as the entry. This is your ultimate refinement tool. When a market moves with incredible force and leaves behind a sudden, massive amount of orders, it creates an inefficiency. It leaves a gap between the high of a previous candle and the low of the next one. And the thing is, markets naturally want to move from imbalance back to balance. So rather than just blindly entering anywhere inside that wider order block, we're going to use the fair value gap to pinpoint a much cleaner, sniper-like execution. Let's move on and see how this all builds together in section 2, the 5-step entry framework.
All right, here is your exact sequence. Step 1, identify your obvious resting liquidity. So things like equal highs or swing lows. Step 2, and honestly, this is usually the hardest part for people. Wait for the sweep. Seriously, just sit on your hands and do nothing until the trap is sprung. Step 3, once that reversal actually happens, trace it back and mark your order block. Step 4, find the gap left by the impulsive move away from that block and mark your fair value gap. And finally, step 5, wait for the re-entry. Just wait patiently for the price to come back to you. Absolutely no chasing allowed.
Now I want to spend just a quick second refining step 3, marking that order block, because there are a couple of different ways you can actually do this. You can use the range method, which maps out the entire consolidation range right before that big impulsive move. Or if you're looking for a much smaller point of interest, you can use the origin candle method. That's where you map out just the specific doji or reversal candlestick that started the whole move. But pay close attention to the golden rule here. Pick one method and stick to it mechanically. Actually, let me repeat that. Do not switch back and forth. Total consistency is exactly what turns this from random guesswork into a highly repeatable strategy.
And this brilliantly illustrates the absolute pinnacle of the strategy. The ideal setup is when you find a fair value gap nestled right inside your marked order block. You see, you never want to enter on some random fair value gap that's just sitting out in the middle of nowhere. I mean, sure, it might work occasionally for a quick scalp, but for a true high-probability setup, you want that structural imbalance and that institutional footprint to perfectly overlap. That's the sweet spot.
Now, once price actually pulls back into that perfect zone, you have to execute. And that brings us to Section 3, aggressive versus conservative entries.
So, when the price finally taps into your fair value gap, you basically have two choices. The aggressive entry means you enter the exact minute price mitigates or basically touches that gap, you drop your stop loss just below your point of interest, and you target a 2R. That just means a clean 2 times your risk and reward. Now, the conservative entry, that requires a little bit more patience. Instead of jumping in on the very first touch, you wait for a structural shift on a lower time frame. You're waiting for the internal structure to flip, say moving from bearish to bullish, which gives you that extra layer of confirmation before you pull the trigger. But regardless of which one you choose, both styles aim for that strict 2R target.
But you know what happens when the market doesn't actually give you a picture-perfect setup? One of our sources highlighted this great real-world example on NASDAQ futures, where we saw this massive liquidity sweep and reversal, which left a very clear order block. But there was absolutely zero fair value gap on the way down. The candlesticks were just completely, perfectly efficient. So what exactly do you do when step 4 is just totally missing?
Well, if there's no fair value gap, you just have to adapt. You do that by entering directly upon the mitigation of the order block itself. But there is a catch here. Order blocks are usually much wider zones, which means if you use a standard stop loss and place it above the entire block, it's going to be dangerously wide, and that'll completely destroy your 2R target. So here is the advanced solution for you. Place your stop loss just a few pips above or below the specific candlestick that you enter the trade on. The absolute strict requirement here is that this specific candlestick must be a protected level, meaning it has to be the candle that actually swept the liquidity in the first place. Because it already swept liquidity, it acts kind of like an armor plate. If price breaks past it again, your whole trade idea is completely invalid anyway. This lets you take a beautifully small, refined loss instead of a massive hit.
And that brings us to a really critical philosophical shift in Section 4, context over pattern recognition.
So the crucial point is this: not every single sweep is worth trading. You have to filter for quality. The sweep absolutely has to happen at a logical, meaningful level. The displacement immediately following it, it needs to be aggressive and obvious. Your order block needs to be the true origin of the move, not just some random candle stuck in the middle of messy, choppy consolidation. And the fair value gap is there to refine the setup, not to act as an excuse to jump into a garbage trade. If the market is choppy, or if the sweep is just weak, you do nothing.
There's a quote from our source material that I think summarizes this entire mindset shift perfectly. Trading is not about spotting more patterns, it's about filtering. When you first learn these concepts, oh man, it is so tempting to start seeing setups everywhere you look. Every little sweep looks like a trap, every single gap looks like a golden entry. But the goal here isn't to find the most setups. The goal is to find the absolute cleanest ones. It is strictly 100% quality over quantity.
So I want to leave you with this question to really think about the next time you open up your charts. Is your next trade a forced checklist, or is it a logical story? Because everything from your higher time frame bias down to your lower time frame structure needs to align. When everything finally aligns, you aren't just looking at random shapes on a screen anymore, you're reading the precise narrative of institutional control. Thanks so much for joining this explainer, and happy studying.